Hey guys, welcome back to another episode. So today what we're going to talk about is going to be, should you start investing with like individual stocks, or do you want to start off with like a mutual fund or an index fund or something like that, right? So basically, what's going to be better for you. We're going to go over how to choose what's better for you, why it would be better for you and stuff like that, right? Because there's a lot of new investors out there that might, put their money in individual stocks because they offer the best potential long-term returns, right? But if you have years or decades to advance, right, as a lot of, especially these days, right, people are just getting into investing, they can invest in stocks and see your dollars multiply over, you know, decades ago, right? But, you might wonder whether you should buy the individual stocks or, like a fund, right? And a fund is basically just a basket of individual stocks all put together in different, basically different percentages, right? So, while it doesn't have to be an either or decision forever, when you're first starting out, if you're a beginner investor, right, you're just starting, right, it's often better starting with funds because they offer a lot of, conveniences, right? So we're going to take a closer look at why some of them do, and we're going to give you like, a little advice, some tips and stuff on how to choose a fund if that's better for you. So, diversification is going to be a fund's main benefit, right? So, one risk of holding a handful of individual stocks is that if a few failed, it could have a really big impact on your overall return. This is called unsystematic or business risk, right? It's the chance that company specific issues like poor management or lawsuits could cause a stock's price to permanently just tank, just plummet, right? But the good news is going to be, right, is that you can eliminate the risk by owning many companies, right? And that's what diversifying is called, right? So when you diversify by owning, a lot of stocks or a lot of companies, the performance of the, your overall portfolio would be only minimally affected by a few, bad apples, a few poor performers, right? Most funds have dozens or hundreds of holdings, right? You can diversify away unsystematic risk with just one fund in most cases. So for many beginning investors, that type of shortcut is a really huge advantage compared with buying and researching each individual stock, right? You might also benefit from other diversification shortcuts that some of these funds offer, right? There's also risks if you concentrate your portfolio in a specific sector or geography because that area may perform poorly and hamper your returns. Right? So with mutual funds, the portfolio often contains companies across, a few sectors. If you add an international fund or two, you can easily own companies from around the globe, right? This also spreads your bets across more currencies. However, diversification can come with some drawbacks, right? It lessens the impact of high performing stocks, which some investors, that's really what they're going for, right? They want to see those Teslas and Bitcoins, 1,000% returns, right? But it's difficult to beat the market, and you even face more difficulty if you're just learning, investing. You're just like kind of learning about it, getting into it, starting with it, right? And many beginners are going to find that diversification's downside protection outweighs losing out on the small chance of sky high returns, right? So, like I said, the website I like to use is Morningstar. So you can go use, the Morningstar, research area on their website to choose a fund. They got a bunch of details and stuff, right? There's just so many different things you can do, right? And, while a fund can offer shortcuts, beginning investors still should perform, your due diligence to find the right picks. So, you can go use Morningstar or, whatever you want. You could probably just Google, fund research or something like that. And, but more, I know Morningstar has a pretty good one. So the next thing we're going to do is evaluate and choose the right fund for you, or funds, plural, right? So as a first step, you'll need to determine what type of fund you're looking for. So, one area of the market investors often use for core stock exposure is the large cap blend category, which is going to contain large multinational businesses across many different market sectors. For core foreign stock exposure, a lot of investors opt for funds in the foreign stock large blend categories. Another option is a target date fund, which contains various underlying funds that combined can satisfy an investor's diversification needs. And if you don't know what a target date fund is, we've done a previous video on that. You can go check that out later after this video if you want to. Once you've zeroed in on a category or two, you'll need to carefully consider your preferences and circumstances to determine the best fund for what your needs are, right? And these are some considerations, okay? An active or passive, right? You'll have to decide if you want an active fund or a passive fund, right? Because, a passive fund's goal is to replicate the return of a designated market segment, and an active fund seeks to outperform the market segment, right? So you might be thinking, like, why would you choose a fund that won't beat the market, right? Well, many active fund managers underperform in the pursuit of beating the market, and active funds tend to charge higher fees, which can make the average return of passive investments appealing, right? Traditional mutual fund or ETF, right? So you're going to have to decide if you want a traditional mutual fund or an ETF, which is an exchange traded fund, right? I have previous videos on that as well if you guys want to go check that out for this video, right? And so, as a short little thing, basically, an ETF is a fund that trades on a stock exchange, right? ETFs are typically passive investments, which means they track an index, right? Beginning investors won't notice many huge differences between traditional mutual funds and ETFs, so they can usually choose either or a mix of both, right? But one noticeable difference is that ETFs have a tax efficient structure, so you might prefer an ETF if you're in a taxable account. Another thing is costs, right? You're going to want to carefully consider a fund's cost, because every penny that you pay in fees is a penny that's no longer available for you to invest, right? It's easy to find a fund's cost using the quote pages, right? What you can do is you can enter the ticker of the share class that you want to invest in to pull up its quote page, look for the fund's expense ratio, or the annual fee that covers various costs, including the costs associated with managing the fund and selecting investments, administrative costs, and fees associated with brokers that facilitate the purchase and sale of funds. To put the expense ratio into context, you can also check the fund's fee level, which compares the fund's fees against those charged by category peers. You can also see whether the fund has a load or sales charge, right? Another thing that we're going to talk about is going to be investment minimum, right? Many mutual funds have an investment minimum, which is the least amount of money a fund will accept to establish a new account. Some funds have $0 minimums, while others can range from hundreds to thousands of dollars for share classes that are available to individual investors. So, if you require a small investment minimum, you do have some options. Some funds have a $0 investment minimum, so you could choose only funds that meet that criteria. You can buy most ETFs for a specified price that's usually a few $100s at most. You can gain access to funds for less than the investment minimum in many employer-sponsored retirement plans like a 401k, right? So hopefully, you got a little bit of understanding of, why most people go with mutual funds. It's just super easy to get into them, low cost, especially not an actively traded mutual fund, just a passive mutual fund, and it's just super cheap to get into. It's, you don't have to worry about it. It's basically just set up automatic, payment into the account, and just if you've got time to go, right? If if you've got 25, 30, 35, 40 years, right? That's the easiest way to make sure that you're going to get millions of dollars, right? Now, on the other hand, if you've only got 10, maybe 15 years, investing in individual stocks is probably going to be the better way. So it really comes down to, what your time horizon is. So hopefully this information is going to help you guys out. If you guys wouldn't mind, go ahead and give this video a like if you liked it. Subscribe to the channel if you want to see more. And until I see you guys in the next video, y'all be safe.